The UK retail sector stands at a crossroads as it moves into 2025, facing a landscape that is more complex and unpredictable than ever before. Economic uncertainty continues to cast a long shadow, affecting the confidence of both businesses and consumers across the country. With sluggish income growth, rising operational costs, and the looming anticipation of a major government budget announcement, volatility has become the new normal for retailers. Retailers are forced to make tough decisions daily, as rapidly shifting consumer sentiment makes planning for inventory, staffing, and promotions a constant balancing act. Despite widespread anxiety about potential tax hikes and the cost of living, retail spending has shown surprising resilience, buoyed by modest increases in household cash flow and a desire for normalcy after years of disruption. The tension between negative speculation in the media and the underlying financial stability of many households is creating a unique challenge for 2025, as retailers try to read between the lines and anticipate what comes next. To survive and thrive, retailers need to be more agile than ever, closely monitoring trends, customer behavior, and economic signals to adapt quickly to changing conditions. The coming months will put business models, marketing strategies, and leadership skills to the ultimate test, demanding creativity, resilience, and a willingness to embrace new ways of working. For those who can navigate the fog of uncertainty, opportunities still exist, rewarding those who remain adaptable, forward-thinking, and ready to seize the moment as the retail landscape continues to evolve. The financial health of UK households is at a pivotal moment as we look ahead to 2025. Across the country, families are feeling the impact of shifting economic conditions, and their ability to spend is being shaped by a complex mix of factors. This financial stability is the bedrock of retail, influencing everything from daily purchases to long-term consumer confidence. In 2025, primary income for UK households is projected to rise by 5%. However, this positive momentum is expected to lose steam, with growth slowing to just 3.3% in 2026. This signals a tightening of consumer budgets, as wage increases begin to lag behind rising living costs and economic uncertainty. Household cash flow before savings will also decelerate, with a 4.7% increase in 2025 dropping to just 2.5% in 2026. This means that, even before setting aside money for savings or investments, families will have less new cash to work with each year. As wage inflation eases and the cost of essentials continues to climb, disposable income growth will moderate. This leaves households with less flexibility, making it harder to justify non-essential or luxury purchases. As a result, households will become more selective in their spending, carefully weighing value and necessity over impulse buys. Shoppers will increasingly seek out deals, discounts, and products that offer the best return for their money. Retailers must pivot from relying on broad consumer confidence to targeting specific demographics and needs. Understanding the unique challenges and preferences of different customer groups will be essential for success. The era of easy spending is ending. With more cautious consumers, competition for every pound spent will intensify, and retailers will need to work harder to earn customer loyalty. Understanding these shifts in income and cash flow is crucial for survival in a slower growth environment. Businesses that adapt quickly will be best positioned to thrive. The battle for market share will be fiercer than ever as retailers compete to capture the attention and trust of a more discerning and value-driven consumer base. Economic pressures are dramatically reshaping UK consumer behavior, touching every aspect of daily life. From bustling city centers to quiet suburban streets, people are rethinking how they spend, save, and shop. One of the most telling signs is a sharp decline in the national savings rate as households struggle to set aside money for the future. After peaking at 12% in late 2024, the savings rate dropped to 10.9% in early 2025, and forecasts suggest it could fall even further as the year progresses. This downward trend isn't a sign of growing confidence, but rather a direct response to the mounting pressures of rising living costs, stagnant wages, and lower incentives to save as interest rates continue to fall. As a result, households are tightening their belts and spending with extreme caution. Price sensitivity is at an all-time high, and the relentless hunt for value has become a daily reality for many families. Brand loyalty, once a powerful force in retail, is rapidly eroding. consumers across all income levels are switching to cheaper alternatives, prioritizing affordability over familiarity. In response, retailers are being forced to compete more aggressively on price than ever before, making promotions and discounts central to their survival strategies. Shoppers now expect deals and special offers as standard, but this constant pressure to cut prices is squeezing profit margins and challenging traditional business models. The 2025 consumer is more informed, more demanding, and more resourceful than ever before, using technology to compare prices, track discounts, and make every pound count. For retailers, the message is clear. Adapt quickly to these shifting behaviors and savings habits, or risk losing relevance in a rapidly changing marketplace. Housing costs are the most relentless financial strain for UK households, now consuming over 40% of non-discretionary spending. The end of ultra-low interest rates means many homeowners will soon face higher mortgage payments as fixed-rate deals expire. About half of UK mortgage holders will see their rates reset in the next 3 years, leading to significant monthly increases. This mortgage shock is already prompting households to cut back on non-essentials and build financial buffers. Retailers, especially those selling big-ticket items, are feeling the impact as consumers delay major purchases. As more income is diverted to housing, discretionary spending shrinks, directly affecting retail revenues. The health of the housing market is now a key predictor of retail performance. Food inflation, projected to peak at 5% in late 2025, is a daily reminder of rising living costs for UK families. Price hikes are driven by higher supplier labor costs, global commodity swings, and weather disruptions. Shoppers are adapting by trading down to private label brands, planning meals, and cutting back on luxuries. Discount chains are gaining ground as consumers aggressively seek promotions. Major grocers face intense price competition while managing their own rising costs. The challenge balances competitive pricing with margin protection and customer loyalty. Even as wages rise, much of the gain is eaten up by higher food costs, limiting spending elsewhere. Food inflation keeps the pressure on both households and retailers. Utility bills are an often overlooked but growing drain on UK household budgets. In 2025, Ofgem's price cap hike led to a 6% rise in energy costs, while water bills jumped by 26%. These unavoidable expenses further erode disposable income, leaving less for retail spending. Unlike food or clothing, utility costs can't be easily reduced, making them especially painful. The cumulative effect of higher housing, food, and utility costs is a powerful squeeze on family finances. Retailers across all sectors feel the impact as discretionary spending contracts. The competition for what's left of household budgets is more intense than ever. For retailers, understanding these pressures is vital to survival. The Bank of England's recent interest rate cuts aim to stimulate the economy, but their impact is uneven. While lower rates reduce payments for some borrowers, most homeowners on fixed-rate mortgages won't benefit immediately. Falling rates also make saving less attractive, contributing to the drop in the national savings rate. In theory, this could boost spending, but most households are using any extra cash to manage rising costs or pay down debt. The link between rate cuts and retail sales is weaker than it appears. The central bank's actions signal economic headwinds and a need for support. Retailers must recognize that monetary policy alone won't revive consumer confidence. The environment remains challenging, demanding strategic adaptation. Not all retail sectors are equally exposed to 2025's economic pressures. Big-ticket retailers, furniture, DIY, electronics, are most vulnerable as consumers delay major purchases. The replacement cycle for expensive items is lengthening, hurting sales volumes. In contrast, food retailers and value apparel chains are more resilient, as their products are essential or lower cost. Supermarkets provide a stable, if low-margin foundation, while value clothing remains a frequent purchase. This creates a two-speed market. Some sectors brace for tough times, others fight fiercely for market share. Success depends on category, cost control, and targeted promotions. Investors and analysts must understand these divisions to assess retail health. The UK retail landscape is now a mosaic of winners and losers. The fortunes of Next plc and Pets at Home Group plc illustrate the UK retail divide. Next has thrived through a strong online presence, diversified revenue streams, and international expansion, earning analyst confidence and share buybacks. Its price target has risen, reflecting belief in its strategy. Pets at Home, however, faces weak sales and leadership uncertainty, leading to sharp earnings downgrades and a lower price target. Even resilient sectors like pet care aren't immune to the squeeze on discretionary spending. The contrast shows that robust strategy and adaptability are key to surviving 2025's challenges. Companies with strong leadership and diversified models can still outperform. Those exposed to wavering demand and internal disruption face a tough road ahead.